So we're going to start from purchase of non-current asset. That is chapter number 3. Now, the purchase of a non-current asset, it is relevant to when we purchase any asset that we planning to use in the business, but not to sell. For example, like we have two types of asset. One is a current asset and one is a non-current asset. The definition of the non-current asset is when business buy a asset with the intention to use it. For example, they can buy a furniture, they can buy a computer, they can buy a sofa, they can buy a land, they can buy a building. So any sort of asset, if they buy with the intention to use it in the business, then we called it non-current asset. Sometimes we called it fixed asset. Now, non-current asset or fixed asset, normally they use it for more than 1 year or more than 12 months. So this is the definition of non-current asset or fixed asset. But for this chapter, we just need to know what sort of expense can be included on the non-current asset and which one we cannot include. Now we have two types of expenditure. When a business buys something, we have a expenditure. So we have two types of expenditure. One is a revenue expenditure and one is capital expenditure. What is the difference between these two? The capital expenditure only for the non-current asset. For example, if we buy something and if we have a plan to use it in the business for more than 1 year, we called it non-current asset, or we called it fixed asset. So any sort of expense we make for the, or any sort of expenditure we make for the non-current asset, we call capital expenditure. So capital expenditure is relevant to our financial statement. So if we buy something, any asset, we record it on our statement of financial position or in the balance sheet. On the other hand, we have some revenue expenditure. Now, revenue expenditure means to run the business a daily basis. So on the day-to-day operation, we need to spend some expenses, for example, for the rent, for example, for the telephone, for the purchase. So this sort of thing that we have to spend to run the business, we called it revenue expenditure. Now, sometimes we called it overheads. Now, obviously, when you prepare our financial statement, we have to record all of this in the profit and loss account. So profit and loss account represent how much is the income and how much is the expense. So from the income, we take away all the expenses to find it out how much is the profit for the year. And the company have to pay tax on the profit. For that reason, you have to find it out how much is the income for the whole year and how much is the expense for the whole year. So we minus the expense from the income, and the difference we have, we called it profit, and we calculate the tax on the profit. So for that reason, it is very important to understand. So capital expenditure, that is relevant to our financial statement or balance sheet. But on the other hand, revenue expenditure, it is linked to our profit and loss account. So this one we have to know. Last week we have discussed a little bit about the financial statement template, but as I said, more you read, you will understand more. So let's have a look the chapter overview, what we have in this chapter. Now, in the chapter overview, we can see we have a few information. The first thing we can see, we have the cost, authorization, accounting entries. So let's little bit explain everything before we actually do any question. So we have a capital versus a revenue expenditure. So we have a capital expenditure. So capital expenditure is all about when you buy some non-current asset. So purchase of NCA, purchase of non-current asset, purchase of non-current asset, or we can call it fixed asset as well, same thing. So when you buy something that is fixed asset and we buy with the intention to use it in the business, we called it non-current asset, and any sort of expenditure we make against the non-current asset, we called it capital expenditure. Now, obviously, this capital expenditure linked to statement of financial position, SOFP, statement of financial position, And this one also called in balance sheet. So this is the story of our capital expenditure. The next one we have the revenue expenditure. Now the revenue expenditure, mainly the expense we made day-to-day basis. Day-to-day basis in order to run the business. Day-to-day basis in order to run the business. So the expenditure we make day-to-day basis in order to run the business, and a revenue expenditure is relevant to profit and loss account, P&L account. Now, in the revenue expenditure, it's relevant to mainly the expense. As I said, it could be the just the overheads. For example, the rent, rates, advertising, wages and salaries. This sort of thing is relevant to our revenue expenditure. Then we have acquisition of non-current asset. Acquisition of non-current asset. Acquisition of non-current asset. Now, acquisition of non-current asset. Acquisition means purchase. Acquisition means purchase, and purchase of non-current asset. Non-current asset means fixed asset, the asset we're going to use more than 1 year in the business. Now, the cost. So what sort of cost I can include as a part of the non-current asset that we're going to look at here. So you have following item. The following items are capitalized as a part of the cost of a non-current asset. The following items are capitalized as part of the cost of non-current asset. So we need to find it out. The cost of purchase, including delivery. That means if we buy something and if we pay the delivery cost for that, that will be the part of our non-current asset. For example, if you buy a computer for £500 and if we have to pay the delivery cost £50, so the total cost will be £550. So delivery cost is part of our total cost. Then the next one we have a cost of construction, including own labor cost. So for example, if I need to pay something to set up that machine, for example, if I buy a computer, but I don't know how to fix it, I don't know how to put the Windows, I don't know how to install it. So if I need to pay something for that, for example, if I need to bring this computer in the shops to fix it, or if someone do that for me, or if I do myself, how much will be the cost to fix it? It can be the part of the cost. Then we have the site preparation. So we have cost of site preparation. Cost of site preparation is all about like if I need to prepare the site. For example, if we have a plant and machinery, and if we need to make something, for example, there in order to fix the plant and machinery. For example, if we need to prepare the site first because it is necessary for the plant and machinery. So if we need to pay something for the labor, that will be the part of our cost. Then we have a cost of testing. Cost of testing. So if I need to bring someone to make the test, it will be part of our cost. Then we have a professional fee. So if I need to pay any professional fee, that will be our part of the cost. Now, for example, if I buy a house, I need to pay for the surveyor fee. I have to pay the legal cost. So without this, I cannot buy the house or buy the land. For that reason, this will be our part of the cost. So if anything that is necessary to make acquisition of that asset, this can be the part of cost, because without this, if we cannot have the asset, so that can be the part of our cost. The next one we have here the VAT. Now remember, if the business is a VAT registered, that means the VAT is not the cost for them. So if the business is VAT registered, the VAT is not the cost for them, because VAT obviously can be claimed back from HMRC. So as a VAT registered company, how much VAT I paid, I can always claim it back. So it is very important to know. And obviously, like if I'm VAT registered, VAT is not the cost for me. But if I'm not registered for the VAT purpose, then I have to consider the VAT as a part of the cost, because I'll not be able to claim it back. So if I'm not VAT registered, VAT is also my cost. The next point we have for the authorization. So we have made prior to the purchase and by the appropriate level of personnel. Then we have avoid being purchased unnecessarily, help ensures items are brought at the best price and on the best terms. The first one is like there is a people who is in charge for a different sort of purchase. For example, let's say the purchase clerk, he is responsible only for purchase of the stationery, and the maximum value maybe cannot be more than, let's say, 1,000. But if you are a so if you are a director or the manager, maybe you have a more authority to purchase. So obviously, like a different designated people, they will have a different sort of right and authority to buy different sort of level of purchase. Also, the authorization, avoid being purchased unnecessarily. For example, if you don't have to authorize from any of your superior or from any of your manager, then it is possible they can buy unnecessary thing even they don't need it. So for that reason, it always has to be authorized by the directors or from the line manager, from the finance director, so that they knows like, is this items is necessary or this purchase is necessary for the business or not. Then help to ensure items that are brought at the best price and on the best terms. So basically, this means that when you buy something, we need to make sure like we have checked enough like to the different suppliers so that we can have the best price. So it is possible maybe you buy something from somewhere because you don't want to check, or maybe you don't want to look for a different supplier, or maybe you haven't done enough negotiation, or it is possible maybe you have some your own benefit, you buy from there, from your relatives, from friends. So for that reason, you have to check like the item we're buying, what is the best price for that. For that reason, the authorization is very important. The next one, we have accounting entries. Accounting entries represent how accountants entries represent how to record. If you buy something, how to record in the accounts in the form of journal. That means a debit and credit. So when you buy something, obviously you have to record on our accounts. So obviously for the accounting record purpose, we need to make sure we have recorded in the correct form of journals. So if we buy something, any non-current asset, for example, land and building, for example, car, motor vehicle, anything we buy, we have to remember this journal. So asset is always debit. So if we buy asset, asset is coming to the business. So asset at cost. So how much is the cost of the asset that we have calculated here? How much cost can be? So this cost will be debit. Asset at cost will be debit. And because of the buying of this asset, the money will go from the bank. So if we buy any asset, the money from the bank will be reduced, and for that reason, the bank will be credit. So if you have a doubt about your debit and credit, how to calculate, you need to make sure you read your debit and credit very well. Watch some video from the YouTube for the debit and credit, but make sure your debit and credit has to be very good. So how to identify what is debit and what is credit is very important. So asset at cost is debit and the bank is credit. All right, so let's move on. Let's have a look what else we have. Now we have introduction. The first thing we can see here, the first activity we have, they said, can you give us some example of the non-current asset? Now, as I said before, the non-current asset is the asset that can be used in the business more than 1 year, and the business buy this asset with the intention to use in the business but not to sell. So the example of the non-current asset could be, number one, we can say land and building. Land and building. Land and building is a very common non-current asset. The business buy because they want to use it on the building, the operation. Then the plant and machinery. Plant and machinery. Now the plant to represent, like if you set up a fixed machinery, for example, if it is something quite big, we call it plant. And if it is a small thing, we call it machinery. Then let's say the car or motor vehicle. Motor vehicle. Then for example, we can say furniture. Furniture. And we can say computer. All of this is our non-current asset because we buy it to use it in the business. All right, now we have the definition for the revenue and capital expenditure that we already discussed, but quickly read this definition. It says capital expenditure results in the acquisition, replacement, improvement of a non-current asset. So it could be acquisition, could be replacement, could be improvement of non-current asset. When you have a improvement, it is also part of the capital expenditure. For example, if you have a computer and the computer have a 2 GB RAM, so you now replace it and you make it 4 GB RAM or 16 GB RAM. For that reason, the efficiency of the computer will be increased. It will be faster. So if you make an improvement, then it is a capital expenditure. For example, you have a house, it was before 2-bedroom. Now you make extension, make it 3-bedroom. So if you make it 3-bedroom now, so it is improvement because it was before 2, now it is 3. So this sort of thing is also our capital expenditure. And the replacement is also our capital expenditure. For example, you had a computer before, now you want to have the new one, so you replace it. So it is also capital expenditure. On the other hand, you have revenue expenditure. As we discussed before, the revenue expenditure is all about the day-to-day expense that made by the business. For the trade of the business or to repair, maintain and service non-current asset. So normally it is the repair and maintenance. The revenue expenditure mainly for the non-current asset, it is a repair and maintenance. So repair and maintenance kind of the ongoing service. For example, let's say you have a machine, you have a big printer. So every month you have to change the toner, you have to make some repair and maintenance, you have to clean. So this sort of thing is your ongoing work that you have to do every day. This is your revenue expenditure. For example, the insurance, this sort of thing is your revenue expenditure. All right, so this is it here. Let's move to the next one. And we have the classes of non-current asset. We know this one, the cost. Let's quickly have a look what sort of cost we can include as a part of the cost. So you can see here is the cost of an item of property, plant and equipment includes the purchase cost. So if you buy property, plant and equipment, the purchase cost will be the cost. Then any cost directly attributable to bringing the asset to the location and condition necessary for it to be capable of operating the manner intended by the management. So this is kind of the definition of the cost. Now, what sort of cost can be capitalized? You can see here the list. So cost of the purchase, including the delivery. So how much I paid for the non-current asset and how much is the delivery cost. Both can be added as a part of the cost. Cost of construction, including own labor. So I need to do any construction. If I need to do any labor work to make the asset ready to use, that can be added as a part of the cost. Cost of site preparation, including own labor. If I need to prepare the site to make the asset ready to use, how much I paid, it can be the part of the cost. Cost of installation and assembly. So the cost of installation and assembly. So if I need to install that asset and for the assembly, if I need to pay, that will be the part of the cost. Then cost of testing, if I need to make a test, and professional fee, all this can be added together to find it out how much is the total cost. And this cost will be capitalized in the financial statement. The following item must not, very careful, must not be capitalized as a part of the cost of non-current asset. The following items must not be capitalized as part of the cost of non-current asset. Repair, maintenance, and servicing cost. Repair, maintenance, and servicing cost. So these three cannot be the part of the cost. So repair, maintenance, and servicing cost. Repair, maintaining, and servicing cost. Administrative and general overhead. Admin and general overhead. So overhead cannot be the part of the cost. So this we have to ignore. Remember that in the exam, most likely you're going to see repair and maintenance and service cost. All right, let's move on to our next section. On the next page, we have activity 2. Let's have a look at this activity and let's see if we can solve it together. So let's try this question. So we'll say, on 10 December 2017, a business brought a machine. The policy is to capitalize over 300. So if any cost more than 300 total, remember that, total 300. So adding all the costs together, if it is 300 over, then we can capitalize it. If it is less than 300, we don't have to capitalize. We can record as a revenue expenditure. So the breakdown of the invoice, breakdown on the invoice showed. So we have a cost of the invoice. So cost of the machine is 20,000. This is the cost. Cost means the actual purchase cost, how much you actually paid for that machine. This is the purchase cost. The delivery cost, remember that we can always add the delivery cost. Delivery cost is part of our cost. 1 year maintenance contract, remember that, never ever take that. The maintenance contract, never ever take that. Maintenance contract, we cannot take that because it is a revenue expenditure, and the revenue expenditure cannot be the part of the total cost. Then we have installation cost. Yes, we can take that, plus that installation cost can be the part of the total cost. That's it. So we have to add 20,000 plus 200 plus 500. And or we can just like 21,500, we can minus the 800, it will give you the same figure. So this will be the total amount of cost, that will be 20,700. So that will be our total cost. Okay, let's move to the next one. Anyone have any question from this one? If you have any question, you can write it down, or if you like to ask anything, you can make a note. So on the after the lesson, you'll be able to ask me any question you have. All right, let's move on. The next one we have here, capital versus revenue expenditures. Here we have to identify which one is the capital expenditure, which one is a revenue expenditure. So let's try to do this question, capital and revenue expenditure. On 9th August 2017, a business brought a building. The business has a policy of capitalizing expenditure over 500. All items listed below exceed this amount. So all the items, so they said every single item we have here, this is all more than 500. Indicate whether the following items should be treated as a capital or revenue expenditure. The first one we have here, cost of the plot. Cost of the plot. So if I buy a plot or if I buy a land, the cost of the plot is always capital expenditure. Remember that it is always capital expenditure. The next one is surveyor fee. Surveyor fee is the legal fee that we have to pay, or this is necessary to buy the land. Without paying the surveyor fee, we will not be able to buy the land. So it is part of the cost. So we say it is also capital expenditure. Legal fee for drawing up the purchase contract. So this is for the solicitor. If I like to buy land, I have to take a help from the solicitor and I need to pay for that. So it is part of the professional fee cost. So that will be our capital expenditure. Cost of resourcing alternative building to purchase. Now this one is a revenue expenditure. Remember that, because I'm looking to see if I can buy the same property in somewhere else. So if I look for that and if there is some cost involved with that, this is the revenue expenditure, because even I buy the building or not, this cost will be gone anyway. So research cost, remember that all is revenue expenditure. Research cost cannot be capitalized. All right, this is the differentiation. We can find it out, the difference between the capital expenditure and the revenue expenditure. Let's move to the next section. The next section, we have VAT and the non-current asset. Now the VAT and the non-current asset is quite simple. Remember that if the business is a VAT registered, then the VAT is a cost for them. If the business is not VAT registered, but if the business is a VAT registered, then the VAT is not cost for them, because they will get the VAT back from HMRC. So if you are a VAT registered business and if you pay any VAT to HMRC, you can always claim back. Or if you pay any VAT to the supplier, when you buy something, you can claim it back. But if you are a non-VAT registered business, then you will not be able to claim it back, because you cannot claim, you are non-VAT registered. Let's have a look. This example, illustration 2, is the registration status of business and non-current asset. The principles are illustrated through the following scenarios. So VAT is charged 20%. VAT rate is 20%, it's fixed anyway. Even the question doesn't mention that, always remember the VAT rate is 20%. Scenario A, LV is a VAT registered and acquire a machine 20,000 plus VAT. Now 20,000 plus 20% VAT, that will be 4,000. So the total he paid to supplier 24,000 for this machine. He need to pay 24,000, 20,000 for the machine, 4,000 for the VAT, that is 20% of 20,000. At what amount should the machine be capitalized? Now the question said, the first scenario, VAT registered. This is a VAT registered business, VAT registered. If the company or if the business is VAT registered, the VAT is not a cost for me because I'll get it back. For that reason, we can only take 20,000, not 24, because 4,000 I'm paying initially to the supplier, but later on I'll claim it back. Scenario B says OM is not registered VAT. So he is not registered for VAT and acquire the same machine, 20,000 plus VAT. So this time you can see the cost will be 24,000, not 20, because they are not registered for the VAT. So they cannot claim back the VAT from HMRC. For that reason, VAT is the cost for them. All right, so I think that's the illustration. And the other thing is not very difficult. Authorization. Now the authorization is all about like who is authorized for what level of transaction. For example, if the transaction or the amount of spending is not very high, maybe the purchase clerk, he is responsible for that. But if the amount is quite high, if it is a big amount, maybe the line manager or the finance director, they will be responsible for that ordering. Also, authorization is required before make the order. So for example, if you like to buy something £5,000, maybe you have to get the authorization from the finance director. And if you like to buy something, if the amount is £50,000, maybe you have to get it signed by the directors. Say business needs a new computer costing $450 for the accounts department. Organization policy is that the authorization level as follow. So we are planning to buy a computer and the cost is $450. And the company authorization policy is if the cost is less than 600, it has to be authorized by the supervisor. If the cost is between 600 to 2,000, it has to be authorized by the Manager. If the cost is over 2000, then the business owner. Now 450 comes under 600, so that means it will be authorized by the supervisor. So you can say the account department supervisor. So this will be the right answer. So the authorization policy is not very difficult. So based on the company policy, you have to choose the right one. All right. Let's have a look at this one. Then we have the accounting for non-current assets. So what happens if we buy any non-current asset? Now we have to remember one thing, like when you buy non-current asset, what happened? So if you purchase any non-current asset, the asset will come to the business. So if we buy any non-current asset, the asset will come to the business. So asset will be debit. So asset at cost will be debit, because we're buying the non-current asset, it will be debit. And the bank will be credit, because the money will go from the bank. So bank will be credit if we pay immediately. If we pay immediately for that. This is number one. Number two is, it is possible like you buy an asset, but you didn't pay for that immediately, you'll pay later. So in this case, if you pay later, then you will be asset account will be debit, asset at cost, because asset is still coming. Asset cost will be debit, but this time it will be payable. Payable will be credit, because we did not make a payment yet. Number three, it is possible you can take a loan to buy the asset. Now, if you take a loan from the bank to buy the asset, there will be two journals involved. The first one will be when you take a loan. So the bank will be debit, because if you take a loan, money will come to the bank. So your bank will go up, bank will be debit. And the loan will create a liability. So loan account will be credit. Because if we take a loan, it is a liability for us. You have to pay the loan back. So loan will be credit. And later on, if I use this loan to buy the asset, then asset will be debit. Asset cost will be debit. And this time, the bank will be credit, because if I use the bank to pay the money to buy the asset. So there'll be two journals. If we take a loan first and use this loan money to buy the asset. But ultimately, if you see, the bank is debit, a bank is credit. So if a debit and credit is gone, so we have only asset debit and the loan credit. So this is how we need to understand how to record purchase of non-current asset in the form of journal entry. All right, so let's move on to the next section. Also, if there is a VAT, remember that VAT is also expense if you buy non-current asset, and if you have to pay the VAT, so you have to say non-current asset at cost is debit. VAT is also debit, because VAT is expense for you. When you buy an asset, VAT is expense for you, and the bank will be credit, because you pay from your bank. All right, let's move to the next one. So we have activity 4. Let's try this one. It says recording a machine in the GL, general ledger. How to record if I buy a machine in the general ledger? So the business brought a machine costing 12,000. The machine was paid for in cash. The policy is to capitalize expenditure over 500. Ignore the VAT. So there is no VAT. We have to ignore the VAT. And 12,000 is more than 500, so we can capitalize it. There is no problem for that. Record the journal entry needed in the general ledger to show purchase of the machine. So what is the journal entry you have to show when you purchase the machine? So we will have machine at cost. Machine at cost, debit 12,000, and the bank, because we pay for that immediately, bank will be credit 12,000. So asset is coming, that's why it's debit, and money will be gone from the bank, so bank will go down, so it will be credit. All right, let's move to the next one. The next one, we have activity 5. We can see, let's read this question. Recording a motor vehicle in GL, same question, but this time I think it is with a loan. So let's try that. A business acquired a bank loan. So business took a bank loan of £18,500 to purchase a motor vehicle costing £18,500. The policy is to capitalize expenditure over 500, ignore the VAT. So this time I took the loan first, and I have used this loan to buy the non-current asset. So first, a journal to record the bank loan. If I take a loan, what happened? If I take a loan, my money will come to my bank. So my bank will go up, my asset will go up. So bank will be debit because I took a loan. Bank is debit 18,500. So my bank will go up by 18,500. And at the same time, it will create a liability because if I take a loan, I have to pay it back. So loan account will be credit. Loan is credit 18,500. Then later on, I have used this loan to purchase the motor vehicle. So now I'm going to say asset will be debit. Asset account, that is 18,500. Debit. And the bank will go down because if I pay from the bank will be credit. So asset will be debit, bank will be credit. If I buy something and if I pay for that from my bank, so my bank will go down and bank is credit. So this sort of journal will be in the exam. We have to make sure like you remember this journal because we have to memorize it. All right, let's move on to our next section. The next one, we have activity 6. Let's have a look what we have here. On the activity 6, we can see here we have VAT and purchase of non-current assets. A VAT registered business, this time the business is VAT registered. So that means the VAT is not cost for me. A computer 1,000 plus VAT. So 1,000 plus 20%. That is 200. So it will be total 1,200. Total I have to pay to the supplier 1,200. But even though I'm paying 1,200, but my actual cost is 1,000 because I'm VAT registered. VAT is not the cost for me. The acquisition is a cash purchase. The acquisition is a cash purchase. The VAT rate is 20%. So acquisition is a cash purchase and the VAT rate is 20%. The policy is to capitalize expenditure over 300. So if the total cost is more than 300, I can capitalize it. That means I can record it on our financial statement. Record the journal entry needed in the general ledger to show the purchase of the computer. Okay, so very important. Now how much cost I'm going to show? I'm going to show 1,000, not 1,200, because the VAT is not the cost for me. So I said computer at cost. Computer at cost. That is 1,000. Asset is a debit. Then the VAT is also expense for me. So VAT account will be debit 200. And finally, from the bank, I have to pay 1,200. So bank is 1,200. So I need to pay 1,200. So 1,000 plus 200 is equal to 1,200. So I'm paying 1,200 to my supplier from my bank. But actually, my cost I'm going to show on the financial statement 1,000 because this 200 I'll claim back from HMRC. That's it. All right, I think this is the end of our chapter number 3 for this cost or purchase of non-current asset. We don't have much thing here. We can see double entry, so you need to memorize this sort of double entry for your exam. So you need to make sure you revise it and you memorize it. Chapter summary, you can see this is the end of the chapter. So move to the next chapter. And this is your test of learning. This will do after your lesson. You will practice this one after your lunch break. And of course, if you have any question, you make a note for me. So next week we'll be able to discuss that. Okay, then we have depreciation of a non-current asset. Depreciation of a non-current asset. This is our chapter number 4. So let's discuss this one, depreciation of non-current asset. So what is depreciation? And non-current asset, you already know that. So any asset that we are planning to use more than 1 year, we called it non-current asset. And of course, like this non-current asset have a useful life. Let's try to understand what is depreciation. For example, let's say we buy a computer. Let's say buy a computer or PC, that is non-current asset, and we buy it for, let's say, for £500. Now, when you buy a non-current asset, at the same time, the company have a policy to decide how many years they want to use it. So after how many years they want to replace it. So for example, when they buy a computer, company said, like the business said, I'm going to use it for 5 years. After 5 years, I'm going to replace with the new one, because they believe after 5 years, maybe the efficiency will be not the same, or maybe the new computer will be in the market. So they want to change it. They want to replace it. Now, every company have a different policy. It is possible some company can replace this asset after 2 years. Some company can replace it for 5 years. Some company can replace it after 10 years. So it depends on the company. They will decide. But for example, for the time being, we just assume we have a 5 years policy to replace this asset. So after 5 years, we have to remove this information from our financial statement and record the new one. Now, on our financial statement, when you buy this computer for 500, what happened? We record it as a non-current asset on our SOFP, on the statement of financial position. So we record it there. Now, my financial statement said I have an asset, and the asset name is computer, and the value is £500. Now, think about it like I have a plan to use it for next 5 years. Now, it is possible, maybe I'm carrying on this asset on the financial statement. Now, of course, like it is possible, it could be damaged if I could have to sold it before 5 years. This is a different story. But for the time being, we are assuming like we're going to use this asset for next 5 years. Now, let's say we are in year number 1. In year number 1, we show 500, the value of the non-current asset on our accounts, on the record, on the financial statement. But after 1 year, let's say in year number 2, the value is not 500 anymore because I have used 1 year. So after the use of 1 year, the value of the computer should go a little bit down. Then after 3 years, it's go more down. After 4 years, it's go more down. And after 5 years, it should go to 0. So that means every year we have to reduce some value from the non-current asset. And the method we follow to reduce the value of the non-current asset, we called it depreciation. We called it depreciation. For example, at the end of the year, I said, because it is a 500, and I said I'm going to use it 5 years. So if I divide with that, 500 divide 5 years, that means every year the value will go down by 100. That means at the end of the year number 1, the value will be 400 remaining for this computer. At the end of the year number 2, it will be 300 remaining. At the year number 3, it will be 200 remaining. End of year number 4, 100 remaining. And end of year number 5, it will be 0. So on my financial statement, this computer after 5 years, it will be 0, and thus it will be gone from my financial statement. And the way we do it through the depreciation. So if someone asks you what is the definition of depreciation, we're going to say depreciation is the reduction of the value of the non-current asset. Depreciation is the reduction of the value of the non-current asset. Now we have a different method to calculate the depreciation. We're going to look at that. For the time being, now we understand what is depreciation. Now let's move on to the chapter overview and discuss some depreciation method. and how to calculate the depreciation from there. So on the chapter overview, we can see here some accounting and the calculation and everything. So let's start with our accrual concept. What is accrual concept? Accrual concept, sometimes we call it matching concept. Matching concept. Matching concept. Matching concept, the reason we called it matching concept, because we match the transaction with the relevant period. For example, let's say our financial year is January to December. For example, our year is started from January and year is end for my business is December. And let's say for the month of December, the last month, the electricity bill, the electricity I have used, I will not receive the bill until January next year. Because first I need to use the electricity, then I will know how much will be the bill. For that reason, until my year is end, I will not be able to know how much is the electricity bill for the month of December. So when the month of December is end, then on the next month, January, maybe I'll receive the bill, and let's say the bill is £300, for example, for the month of December. Now, I will pay in January from my bank. So from my bank, I will pay in January. But my year is January to December, and this 12-month information I have to submit to HMRC. This 12-month information I have to submit to HMRC. Now, when I look at up to 12-month bank statement, January to December, I'm not going to see the electricity bill for the month of December because I paid this one next year, January. So for that reason, I have to bring it back, because I will say even though I did not make the payment in December, I paid next year, January, but this bills belongs to December this year. So I have to bring it and record it this year. And this is called accrual concept or matching concept. So we match the transaction relevant to that accounting period. So regardless we make the payment, or regardless we receive the money from the customer. So for example, if I make a sales on December and my customer pay me on next year, January or February or after 6 months, but still I need to record on December because I made a sales on December. So even though the customer didn't pay me, it not really matter. Even I didn't pay to my supplier, it's not very important. We just need to know, is this transaction happened on this month or this year or not? So the payment or receipt is not very important. This is called accrual concept or matching concept. Sometimes it's happened, let's say you paid the insurance for the whole year. Now, when you pay the insurance for the whole year, what happened? Like you pay for the whole year. Let's say you paid in June, in the middle of the month, pay for June until next year, June. But my business year is January to December, January to December, and January to December. So every year we do January to December. So what will happen? Even though I paid for the whole year, I can only record it for 6 months for this year. Why? Because another 6 months I paid in advance for the next year. So even though I paid this year, for example, 1,000, I can only claim 500 expense, half for the 6 months for this year. Another 500 I will claim next year, so because I paid in advance. This is very important to understand, and this is called accrual concept, to match the transaction income and expense against the relevant accounting period. So there is some journal here. We have the accrual concept. You can see the depreciation charge is debit. You have to remember this journal. So depreciation is debit because depreciation is expense. For that reason, it is a debit. And credit, non-current asset, accumulated depreciation. Now, accumulated depreciation, remember, it is the total depreciation till today. So we said accumulated. Accumulated means like how much depreciation is already gone from the non-current asset till today. You added all of this. For example, if my depreciation is every month £50, so year 1 £50, year 2 £50, year 3 £50. Let's say we are in year number 3 now. So my depreciation will be £50. Depreciation will be £50 only for 1 year. Remember that depreciation represent only for 1 year. Depreciation represent only for 1 year. But on the other hand, the accumulated depreciation is the total till today. So if someone asks you how much is the accumulated depreciation, you have to add it all of this. That will be 150 is your accumulated depreciation. So accumulated depreciation is the total accumulated together depreciation, but depreciation is only for 1 year. So depreciation will be debit and accumulated depreciation will be credit. Then you have a method of depreciation. How can we calculate the depreciation? It is very important to understand the method of depreciation. We have a straight line method and we have a diminishing balance depreciation. Straight line method and the diminishing balance depreciation. So we have depreciation charge is the same year. Depreciation charge is the same year. The formula is a cost minus residual value. Now, a straight line method is quite simple and straightforward. So a straight line method, all you have to know how much is the cost, how much is the residual value. Now let's try to talk about the residual value. What is residual value? Residual value is the year-end value, or after the year's useful life of the asset, how much is the asset could be sold in the market. For example, as I said before with the computer, let's say we buy a computer in 2022 for £550. And we are saying we can use it for 5 years. And after 5 years, we can sell it for £50. So after using 5 years, this computer, the cost is 550 and I can still sell it for £50. That means 550 minus 50. So my actual cost is 500, not 550, because 50 I'll get it back after 5 years. So it's very important to understand. So 50 I'll get it back after 5 years. For that reason, this residual value is basically the value after the useful life, or after completely you have used the asset, how much you can sell it for. This is called residual value. Now the residual value sometimes is called scrap value. Residual value sometimes is called scrap value. Now residual value sometimes is called scrap value. So cost minus residual value is basically the actual cost, and we divide with the useful life. For example, if I can use this asset for 5 years, so we have to divide by 5. So the depreciation will be £100 each month. So this is very important, number one. Number two is another way you can calculate the straight line depreciation, that is cost minus residual value times by the percentage. That means the question will give us how much will be the depreciation percentage each year. It could be 20%, it could be 25%. So all we have to do cost minus the residual value or scrap value times by the depreciation percentage. That's it. So there is two ways we can calculate the straight line method depreciation. One is cost minus residual value divide useful life. How many years we can use it, that called useful life. So cost minus residual value divide useful life, number one. Number two is cost minus residual value times by the depreciation percentage. And the question will give us depreciation percentage, so nothing to worry about that. So this is one method, straight line method for depreciation. The another method we have to calculate the depreciation, we called it diminishing balance depreciation. Sometimes you called it reducing balance depreciation. One thing you have to remember with a straight line, the depreciation each year, every year, the depreciation remains same. For example, in year one, if the depreciation is 100, year two depreciation will be 100, year three depreciation will be 100, year four depreciation will be 100. So every year the depreciation will remain same. But on the other hand, diminishing balance depreciation, every year the depreciation has to go down. Every year the depreciation has to go down. So here we can see here depreciation charge higher in the earlier year and of the asset life. Depreciation rate, percentage time, carrying amount. So you have to do that. So how we do that is a little bit complex compared to the straight line depreciation method, but it is not very difficult. So all you have to do, you have to start with the cost. For example, my cost is let's say £500. Let's say my cost is £500, and let's say the depreciation is 10%. So you have to minus 10% depreciation. So 10% is give me, for example, 50. And at the end of the year, my carrying value will be 450. So carrying value will be 450. Now, that's all right, Romel. So it should be fine. So you can obviously, this lesson will be recorded, and obviously you'll be able to watch it later on. So 10% will give us 50. So it is 450. Then this 450 at the end of the year number 1. So whatever is the balance 450, it will be like 450 at the beginning of the next year. So 450, it will be beginning of the next year. So 450, now we do again 10%. So 450 times 10%, it will give us 45. Now next year, my depreciation will be 45. So I'll do 45 minus 450, it will give me 405. And year number 3, we'll start with 405. 405 times 10%, we do 10, and that gives me 40.5. So what we understand from the diminishing balance, we can see every year the depreciation is going down. So the first year, the depreciation was 50. Second year, depreciation is 45, and third year is 40, so it will keep going down. For that reason, we called it diminishing balance, or we called it reducing balance. So the depreciation will be lower each year, and also like the carrying value will go down. So you can see the cost was 500, depreciation is 50, so my carrying value is 450 at the end of the year. So at the end of the year number 2, my carrying value is 405, then it will go down, go down, go down. So this is the way we calculate the diminishing balance. First, we need to find the cost, depreciation, then we have to minus from our cost minus depreciation, it will give us the carrying value. And whatever was the closing for this year is the opening for next year. Closing for this year, opening for next year. So at the end of the year, how much is the carrying value? It will be starting for the year number 2. Whatever is the ending for year number 2, it will be opening for year number 3. That's how we'll carry on to calculate the depreciation for our diminishing balance. All right, so this is our chapter overview. Now we can have a look at our activities. So we have talked about this formulas. Remember that anywhere, if you look at this one, if they said formula to learn, remember that you have to memorize it. It will not be given in the exam. Formula to learn means you have to remember or memorize these formulas. Okay, let's try one example. Maybe we'll understand more after. So it says straight line depreciation machine. Straight line depreciation machine. A business is a buy machine for 2,500. A business is buy machine for 2,500. It is expected to have a useful life of 3 years. It is expected to have a useful life of 3 years. After which time it will have a scrap value 250. Now, as I said, the scrap value or the residual value is the same thing. Scrap value, residual value. It is the value at the end of the useful life of the asset that we can get it back. So after the end of the year number 3, after using it 3 years, I can sell it for £250. So calculate the annual depreciation charge. How much is the depreciation? So you have to use this formula because it's not with the percentage. So cost minus residual value divided by useful life. So let's try this one together, and obviously like we'll see how it works. So In this question, we have to do just use the formula to calculate how much is the annual depreciation. So we have a cost, and the cost is 2,500. So let's make the formula first. So it's a cost less residual value. Residual value and the scrap value is the same thing as we said before, and the useful life. So the cost we have here, that is 2,500. And the residual value is 250. And the useful life, we can say 3 years. So if we do that, the result will be 750 per year. That means the depreciation is 750 per year. So at the end of every year, 750, the value will go down from this machine. So from 2,500, at the end of the year, 750 will be reduced. So on the financial statement, the carrying value will be reduced 750 by each year. Okay, so it will be 750. All right, so that's it, is our first question. Let's look at the next one. The next one, we have depreciation for each year. So it's going to be same, remember that. So year one, the cost is 2,500. So they said how we calculate the accumulated depreciation and the carrying value. So let's try to do that. So the cost is 2,500, year number one. And the accumulated depreciation, total depreciation so far 750. 2,500 minus 750, it will give you 1,750. Then year number two, that is 2,500, the cost, minus this time the depreciation will be, accumulated depreciation will be more. Year one, it was 750, and year two, it was 750. So 750 plus 750, it will be 1,500. Accumulated means total. Remember that accumulated depreciation represents the total depreciation. So 2,500 minus 1,000, it gives us 1,000. 2,500 minus 1,500 gives us 1,000. Then year number three, 2,500 is the cost. And depreciation will be this time 1,500 plus 750 for year number three. That will be 2,250. And my carrying value will be 250. And this is the carrying value we have left for our residual value. Whatever was the residual value, this is the left, we'll get it back. So this is a story you have to follow in order to show the depreciation and how much is the accumulated depreciation. Accumulated depreciation is accumulated every year. So how much was the last year, this year will be added. How much was the last 2 years, it will be added. How much was the last 3 years will be added. So it will be keep growing. Obviously, like if the accumulated depreciation is more, then the carrying value will be less. All right, let's try another one. So we have here the next one, activity 2, straight line depreciation, and we have a building. Straight line depreciation, and we have a building. A business has the following balances relating to non-current asset. A business has the following balances relating to non-current asset. Balance as at 30 June 2015, 30 June 2016. We have building at cost and 100,000 and 100,000. Buildings accumulated depreciation 12,000 and to be calculated. So they are saying like in 2015, my cost was 100,000. 2016, the cost is still 100,000 for the building. The accumulated depreciation, so 2015, the accumulated depreciation was 12. And that means in 16, it will be more because accumulated depreciation will be added. Whatever is the depreciation for 2016, it will be added with 12,000 because it is always accumulated the depreciation from day one till now. So it will be more. Depreciation is provided 2% in straight line. So on the cost, we have to multiply 2%. If we have any residual value, we have to take it out. So the cost is 100,000 is quite simple. So we said 100,000 is the cost. So 100,000 is the cost. times by 2%, and that will give us 2000. So the depreciation, remember that depreciation means only for 1 year for 2016. Depreciation represents only for 1 year, but the accumulated depreciation is all the depreciation till today. So 100,000 times 2%, the depreciation is 2000. And on the other hand, how much will be the accumulated depreciation as 30 of June 2016? We already have 12,000 depreciation before. 12,000 we have from the previous period. So 12,000 plus in 2016 we have 2,000. So 12 plus 2, it will be 14,000. So we already have till 2015 12,000, and 2016 we have another 2,000, isn't it? And that make us 14,000. The accumulated depreciation. Accumulated means up till until today, or up to today, how much is the total depreciation from the day one. So that's it. This is our depreciation for the straight line when you have a percentage. All right, let's have a look at the next one. The next one, we're going to follow the diminishing balance method. Now, the diminishing balance method will be quite straightforward, but there is a little complexity that we have to understand the way we said before. So let's try one. We'll understand how does it work. Activity 3, diminishing balance depreciation. Every year, the depreciation will be less. Before, with the straight line, we have seen the depreciation is same for every year. Year 1, it is same. Year 2, it is same. Year 3, it is same. But the diminishing balance or reducing balance, the depreciation will be changed every year. Say as a business buy a machine costs 6,000. A business buy a machine cost 6,000. The depreciation is 40% on a diminishing balance. The rate is 40%, and we have to use the diminishing balance. Calculate the depreciation and accumulated depreciation and the carrying value. Three things: depreciation, accumulated depreciation, and the carrying value. That's not a problem. So let's start with that. First, we start with the cost. So the cost is 6,000. Year 1, the cost is 6,000. You start with the cost. Depreciation rate, the question said depreciation rate is 40%. So it's a 40% is the depreciation rate. Depreciation charge. So 6,000 times 40%, how much it is? That will be 2,400. So 6,000 multiplied by 40%, it will give us 2,400. And accumulated depreciation, we are in year number 1, so we don't have any previous depreciation. No depreciation we have carried forward from the previous period. So the accumulated depreciation is still same, 2,400. 2,400. And the carrying value, how much is the carrying value? So carrying value is always cost minus the depreciation. So you have cost 6,000 and the depreciation is 2,400. So that will give us 3,600. That's my carrying value. Now this carrying value, whatever is the carrying value at the end of the year number 1, will be the opening for year number 2. So this 3,600 will be opening for year number 2. So 3,600 will be the opening balance. Whatever is the closing for year 1 is the opening for year 2. Same thing, depreciation rate 40%. And 3,600 times 40%, it will give you 1,440. 1,440. And the accumulated depreciation will be total depreciation till today. So year number 2, we have a depreciation 1,440. And year 1, we have some depreciation 2,400. So 1,440 plus 2,400, that will give us 3,840 total depreciation, this plus this. And my carrying value will be how much? 3,600 minus 1,440. So the carrying value minus the depreciation. So that will give us my carrying value. That will be 2,160. And this 2,160 will be the opening balance for year number 3. 2,160. Same thing, we do 40%. So 21 60 times 40%, it will give you 864. And this time 864 plus 3800, my accumulated depreciation, total depreciation. So we have before 3840, now we have for this year number 3, 864. So 3840 plus 864, it will give us 4704. And the carrying value, same thing, carrying value minus the depreciation, it will give us how much is the carrying value at the end of the year number 3. It's 1296. That's it. That's how we can complete the table. So you can see here the depreciation charge. Year 1, the depreciation is 2400. Year 2, depreciation is 1440. Year 3, depreciation only 864. So every year the depreciation is reducing, going down, and for that reason we called it reducing balance or diminishing balance method. So this is the way we can calculate our diminishing balance depreciation. So there is another method for the percentage that we're going to see on the next example. But before that, let's take a break. Let's take a half-an-hour break. We'll come back around 11:30 and we'll start from our activity 4. If you have any question, make sure you keep a note so that on our question and answer session, you can ask me. So I'll see you at 11:30. The next question we have activity 4 with the percentage, and that is for the diminishing balance depreciation method. So let's read this question and solve it together. It says diminishing balance depreciation vehicles. So we have a business has the following balances relating to non-current asset. Balance as at 31st January 2018, 31st January 2019. So 2 years. Vehicle at cost is 50,000, and accumulated depreciation 2018 we have 32,850 and 2019 to be calculated. So how much we're going to calculate the depreciation? What will be the depreciation here? That will be added with the previous year depreciation to find it out how much is the accumulated depreciation. Remember that. Depreciation is provided 30% on diminishing balance. So 2 questions here. The first question is calculate the depreciation charge for the year ended 31st of January 2019 and how much is the accumulated depreciation. So let's try to calculate that. The first thing we need to know how much is the cost. So the cost is 50,000. And from the cost, we have to minus the accumulated depreciation. That is 32,850. 32,850. This is my accumulated depreciation. So cost minus accumulated depreciation. Cost minus accumulated depreciation. And that will give us the carrying value. So on the carrying value, you have to do the 30% times by 30%. And that will give us 5145. So this is the depreciation charge for this year. So that is 5145. So this is our depreciation. The next one is accumulated depreciation. For the accumulated depreciation, you need to see how much depreciation you already have. 32,850 plus 5145. And that will be my total accumulated depreciation. And that is 37,995. 37,995. 37,995. So that's my total accumulated depreciation. So you have a depreciation and you have an accumulated depreciation. Okay, let's move to the next one. The next section we can see here, they said asset accrued part way through the year. So what happened if the asset is by not beginning of the year? So if the asset is by middle of the year, or maybe like before the year end, or 6 months after the year is started. For example, let's say my financial year is Jan to December, for example. Now, if I buy a machine here in June, if I acquire a machine here, that means from here to the year end, only 6 months of depreciation I need to charge. I cannot charge the depreciation for the whole year because I didn't buy the machine for the whole year. I didn't use the machine for whole year. So it's very important when did you buy the machine and how long you used for up to the year end. So for that reason, we have to calculate this one very carefully. And we have to know how many months we have used. Now, sometimes in the question can tell you like when you buy the machine. So they said like full year depreciation will be charged at the year of acquisition, and there will be no depreciation at the year of disposal. So sometimes the question can say that. That means like when you buy the machine, regardless when you buy it, for example, you buy before the year end or middle of the year, but still you're going to charge the depreciation for the full year. And if you sell that machine, you will not charge any depreciation. So that could be explained in the question. But if the question is said, calculate the depreciation on month by month basis, in this case, we have to see how many months we have used that machine, and we have to calculate the depreciation based on that use. So let's have a look, one question, maybe we'll understand more from there. So we have one example. Let's have a look at this example. It's illustration 1, pro rata depreciation. A business brought a machine for 10,000 on October, 1st of October. So this is the date we purchased that machine. It charged straight line depreciation with a pro rata basis 20%, and year end is December. So you can see very clear from October to December, how many months? October, November, December, 3 months. So for the year ended 2019, we use only 3 months, October, November, and December, because we have used only 3 months. So what is the depreciation for the year end? So we have a 10,000, you can see the cost, 20% is the depreciation, but you cannot take the whole year, you can only take 3 months. So divide by 12 times by 3, it will give you 500. So this would be our depreciation because we have used only 3 months for this year. So if the question give you this sort of indication, how many months the depreciation will be charged, you have to calculate that way. All right, let's do one question and we'll see activity 5. Let's try that. It says asset accurate part way through the year. A business has the following information relating to non-current asset. A business has the following information relating to non-current asset. A piece of furniture described as FUJ838 was accurate on 1st April 2018 for 8,000. So we purchased on April. So it's very important to look at the date, 1st of April. So April we have purchased that. The cost is 8,000. The depreciation is a 10%, is straight line. So depreciation rate is 10%, and we are using a straight line method. Depreciation is calculated on annual basis, charged an equal installment for full month, and asset is owned in the year. So it's very important to understand this line. So depreciation will be calculated each full month. So that means if you buy on April, so it will be start from April. And when is the year end? It depends how many months we have used for that year. Number A is asking, calculate the accumulated depreciation and carrying amount for year ended 31st December 2018. Calculate the accumulated depreciation and carrying amount for year end 31st of December 2018. Now we can see here we have accumulated depreciation, that is total depreciation, and the carrying amount, and the year end is 31st of December. So if we buy on April, so April to December, so how many months we need to calculate? April, May, June, July, August, September, October, November, December, 9 months. So you have to calculate the depreciation for 9 months. 9 months. So let's try to do that. So 8,000 is the cost. 8,000 is the cost. There is no residual value, so you don't have to minus anything. Times by 10%. 8,000 times 10%, it will give you 800 for the whole year, but we don't need the whole year because for this year we have used only 9 months. So divide by 12 times by 9. So that will give us 600. So 600 is the depreciation for that year. So you're going to say the depreciation is 600. And the carrying amount. Carrying amount is very simple. Cost minus depreciation is called carrying amount. So the cost is 8,000 and the depreciation is 600. So the carrying amount will be 7,400. So 7,400 is the carrying amount. This is for year ended December 2018. Now the next year, we have to calculate the depreciation for whole year, because in this year I use only 9 months, but the next year I use it for full year. So you can see here it says calculate the accumulated depreciation and the carrying amount for the year ended 31st December 2019. That means the next year. Remember that next year we have used the depreciation for the whole year, so we don't have to split the month. So we have to say 8,000 is the cost, 10% is the depreciation. So my depreciation will be 800. And how much will be the carrying value depends how much you have left. Now, the question is asking how much is the accumulated depreciation. So this is for 2019. So from 2018, we already have depreciation 600. And for this year is 800. So 8 plus 6, we have 1,400. 600 come from the last year, and this year we have 800. So 1,400 is the accumulated depreciation we have here. And the carrying amount, so from the cost, 8,000 minus 1,400, if I minus that, and that will give us the carrying amount, 6,600. That's it. So we need to make sure accumulated depreciation means the last year depreciation will be also added with this year depreciation. Very, very careful with that. All right, so let's move to the next one. The next one, we have accounting for depreciation, how we record the depreciation in the form of debit and credit. So how do record the journals for depreciation? So the depreciation journal is always depreciation is expense, so it will be debit. Depreciation charge is expense. For that reason, it will be more debit. And accumulated depreciation will be credit, because it will reduce the value of the non-current asset. So depreciation is debit and accumulated depreciation is credit. You have to remember this journal because it will be definitely in the exam. All right, let's have a look how we record the depreciation on the financial statement. So let's try to do this activity, activity 6. It says, using the information in activity 1 that we have done at the beginning, straight line depreciation machine, assuming the machine was cash purchase. Okay. Show the journal entry to record the depreciation at the year end. Journal entry to record depreciation charge. Okay. So as we know, the depreciation will be debit. So depreciation charge is a debit and the amount was 750. If you remember your activity 1, we have done 750, and machine accumulated depreciation is a credit, 750. Debit and credit always has to be equal. Remember that debit and credit always has to be equal. So depreciation is expense is a debit and accumulated depreciation is always credit. The next one is says number B, in the T account record the entries in the machine at cost, show the balance and the balance PD, entry in the bank in the SOAP, entry in the depreciation and the accumulated depreciation. They said make a 4 account for the ledger account for for this transaction. Now, before we do the ledger account, we know how to do it. So let's make our journal. So if when you buy a non-current asset, the journal is machine at cost is debit and bank is credit. So machine at cost is debit, bank is credit, number one. Number two is for the depreciation, the journal is depreciation debit. So depreciation charge debit and accumulated depreciation credit. Accumulated depreciation credit. Number three, we have to see is there anything else we have. So we need to record that as well. If there's a disposal, if you sell this asset, we're going to look at. But for the time being, I can see only these two. That is recording the asset and also the depreciation. Now let's record in our ledger account this information on the T account. In this time, can all of you write your name for the attendance, please? Everyone, just write your full name on the chatting box. That will be your attendance. So we will go a little bit down and have to complete this one. Okay, so we have the first one we have here, that is the machine at cost. So have a look, the machine at cost. So machine was 2,500. So machine at cost. So machine is a debit. On the debit side, we're going to write the bank. Bank 2,500. And that's it. You have buy only one machine from the bank. So bank will be on the debit side. So we have 1, 2, 3. Can everyone write your name for the address? Mario and Roshan, to make sure write your name on the chatting box for attendance, please. Okay, so then the next one we have, so we have a bank. So of course we just buy one asset, that's why it is a bank. And we don't have any other assets, so it will be 2,500 and 2,500. And that will be our balance CD. So balance CD 2,500. The next one we have a bank. So bank is a credit. So on the credit side, we're going to write machine at cost. And that is 2,500. Then you have a depreciation charge. Depreciation is a debit, but it's a 3 years. If you remember, we have calculated depreciation for 3 years. So you have to make 3 years depreciation. So let's make the 3-year depreciation. So and then we have 2 gems. All right, so and the next one we have here for the depreciation. Now the depreciation is debit and accumulated depreciation is credit. So on the debit side, we're going to write accumulated depreciation. Accumulated depreciation. Depreciation, that is 750. And every year it is same. Accumulated depreciation 750. And accumulated depreciation 750. And all the depreciation, remember that all the depreciation will go to profit and loss account. Very careful with that. All the depreciation will go to profit and loss account. So you're going to say P&L account 750. P&L account 750. All the depreciation belongs to profit and loss account. That's it. And finally, you have accumulated depreciation, that is credit. So on the credit side, you have to write the depreciation. And that is accumulated depreciation will be increasing every year. So the first year it will be 750. And the balance sheet will be 750. And accumulated depreciation belongs to a statement of financial position. Remember that, not profit and loss. Then year number 2 will have another 750. Depreciation 750. So now my new balance will be 1500. Balance sheet will be 1500. And this balance sheet will be balance period, of course, for the next period. And year number 3 will be depreciation again, 750. And at the end of the year number 3, the balance sheet will be 2250. So that every year, the last year depreciation will be added with the accumulated depreciation. All right, so let's move to the next one. The next one we have activity 7. Let's try that. So here it says ledger accounting for non-current asset. It says this task is about ledger accounting for non-current asset. You are working on the accounting of a business that is registered for VAT. So that means the business is registered for VAT. The financial year end is 31st of August 2019. A new vehicle has been acquired and VAT can be reclaimed on this vehicle. The cost excluding VAT was 28,000 and this was paid from the bank. The residual value is 4,000 excluding VAT. Estimated that it will be used for 4 years. Vehicle are depreciated on a straight line basis. Full year depreciation will be applied in the year of acquisition. This line is very important. A full year depreciation is applied in the year of acquisition. That means the year I will buy this asset, full year depreciation will be charged on that year. The year I'm going to buy that asset, the full year depreciation will be charged on that asset. Depreciation has already been entered in the existing vehicle. That means we have some more asset and some depreciation is already recorded in the account. Okay. The first question we have here, calculate the depreciation charge for the year on the new vehicle. How much is the depreciation charge for the new vehicle? So you need to tell that. Calculate the depreciation charge for the year on the new vehicle. So let's try to do that. Same story, cost minus the residual value divide the useful life. So the cost is 28,000. Residual value 4,000. And the useful life is 4 years. And that will give us 6,000 depreciation per year. So you're going to say 6,000 the depreciation per year. Now it is not important when did you buy it, because they said full year depreciation will be charged in the year of acquisition. All right, the next thing we have here, that is our ledger account. Same thing we done before, so we'll do the same thing. So we buy the machine. So machine at cost is a debit and bank will be credit. So on the debit side, we're going to write the bank. And that is 28,000, the cost price. There's only one machine you have purchased, so it's done here. We have to add this to find how much is the total. That is 64,000. And this is my balance CD, 64,000. 64,000. The next one, we have a depreciation. Depreciation is a debit. So on the debit side, we're going to write accumulated depreciation. In the exam, you really don't have to write anything, because if you click this black drop down list, all the list will come up. You have to select the right one. So the depreciation we calculated 6,000. So you already have some depreciation. 6 plus 9 is 15,000. So we're going to record 15,000. And the balance CD is not balance CD because it's a depreciation. It will be profit and loss. P&L account, 15,000. Then you have a vehicle accumulated depreciation. Accumulated depreciation is always credit. On the credit side, we're going to write the depreciation charge. And that is our 6,000 that we have calculated. And 18 plus 6 is 24,000. And this item belongs to SOFP. That means you have to do the balance CD. Remember that any item, if it is belongs to if it belongs to profit and loss account, then you don't have to do balance CDBD. You need to do profit and loss account. If the item belongs to SOFP or statement of financial position, only that time we have to do balance CD and BD. All right, so I think that's it. Our discussion. Then there is some double entry that we have to remember. That is our depreciation charge debit and accumulated depreciation charge credit. We have some assessment focus point. They said in your assessment, you will be asked to calculate depreciation. You must read the requirement carefully to ensure that you use the correct method. It's very important to understand that. All right, I think this is the end of our chapter number 2. This is the chapter summary. So we have learned today the cost of the non-current asset, so purchase of non-current asset, and also how to calculate the depreciation. We have learned some method, the straight line method and the diminishing balance method. Also, we learn how to record this depreciation on the ledger account. So I hope, like, if you practice, it will not be very difficult, but it could be very much tricky if you don't remember, if you don't practice enough. And it will be definitely in the exam for 10 marks. So you need to make sure like you revise all of this once again. And more you practice, you'll be more confident.